The Fed repo explosion. Why $50 billion just vanished overnight, and nobody's talking about it. Friday afternoon. Halloween. While everyone else was out grabbing candy or carving pumpkins, something terrifying was happening deep inside the financial system. Behind the scenes, the Federal Reserve's emergency repo facility, the overnight oxygen supply for Wall Street, suddenly exploded in usage. Over $50 billion was borrowed in a single day.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline.
Mistakes are made under different names. What we're watching right now, this massive, sudden spike in repo borrowing, is a symptom of something much deeper than a technical adjustment. It's a sign that the plumbing underneath the financial system is starting to clog again. For the last several weeks, repo usage has been quietly climbing. A few billion here, a few billion there. Then 10 billion, then 20, now 50. When you see that kind of acceleration, it means one thing. Liquidity is drying up. The Fed wants us to believe this is just the result of quantitative tightening. That as they shrink their balance sheet, reserves in the banking system naturally fall, and markets adjust. But that explanation collapses the moment you look at the data. Repo rates, the interest banks pay to borrow overnight, have suddenly spiked above the Fed's target range. That's not supposed to happen. It means banks are hoarding cash. It means someone out there doesn't trust the system. And this is where it gets unnerving. The Fed doesn't even directly target the repo market. They watch the federal funds rate, a tiny, largely irrelevant corner of the money system. Meanwhile, the real action, the multi-trillion-dollar global web of short-term lending that keeps the financial system liquid, is ignored until something breaks. When repo rates rise and banks stop lending to one another overnight, that's not just a technical adjustment. That's fear. It means counterparties are starting to question the safety of collateral, the treasury bonds and mortgage-backed securities that are supposed to be risk-free. Jamie Dimon recently said, there are cockroaches out there. And in finance, when you see one, there are always more. This surge in repo usage may be the first cockroach crawling into the light. In 2019, the same thing happened. The Fed was shrinking its balance sheet. Liquidity quietly evaporated. Repo rates exploded. Within weeks, the Fed had to abandon QT and open the liquidity floodgates. Today, we're watching the same movie play again, only this time, the stakes are higher. The global economy is slowing, credit conditions are tightening, and private credit markets, the so-called shadow banking system, are starting to creak under the weight of risky loans and opaque balance sheets. Think about what that means. The repo market is supposed to be the safest corner of finance. It's where institutions exchange treasuries for overnight cash. If stress is building there, it means cracks are forming at the foundation. And the timing isn't random. This happened on Halloween. right before a weekend, when markets are closed and liquidity is thinnest. Could it be that traders are bracing for bad news on Monday? A bank disclosure? A credit event? Something lurking that hasn't hit headlines yet? Money markets don't move like this without reason. When people with billions at stake start pulling cash and tightening credit, it's because they sense smoke, even if the fire hasn't shown up yet. The Fed insists it's all normal volatility, just the transition from abundant reserves to ample reserves. But look closer, and you'll see the problem. There's still twice as much liquidity in the system today as there was in 2019, and yet we're seeing the same stress patterns reemerge. And that means this isn't just about reserves, it's about confidence. It's about the possibility that some collateral isn't as pristine as it appears. Maybe the risk isn't in the traditional banking system at all, but buried in private credit, hedge fund leverage, or offshore dollar markets that the Fed can't see until they blow up. So here's where we stand. $50 billion in repo borrowing in a single day. Repo rates creeping above the Fed's ceiling. A central bank that says everything is fine. And a market that clearly disagrees. Is this the start of another 2019-style liquidity crunch? Or the first tremor before something bigger? A credit event hidden in the shadows of the system? We won't know until the next wave of data hits. But the signs are undeniable. Tightening liquidity, escalating repo demand, rising risk aversion. The system is flashing yellow. This isn't about panic, it's about pattern recognition. Every major financial crisis starts the same way, with liquidity tightening quietly in the background while everyone else is distracted. And the Fed says, nothing to see here, but the money markets are screaming otherwise. If the past is any guide, what happens next will determine whether the Fed can manage a controlled landing or whether something snaps. If you found this breakdown valuable, hit the like button so more people actually see what's happening beneath the surface. Comment below. Do you think this surge is just QT playing out, or is it a warning shot from the shadow banking world? And subscribe, because when the markets open on Monday, we may finally find out what triggered the $50 billion repo panic.